Every single trading decision that you have ever made was secretly about one concept and one concept only: money. Well, sort of, not actually though. It's actually expected value, EV for short. And I'm talking about your entries, your exits, your stop placement, your position sizing, how often you trade, all of it, one concept underneath every single one. And a lot of retail traders have never heard of it, never thought about it, definitely never tried to calculate it, which coincidentally is why a lot of retail traders are not retail traders for very long. But fear not, my friends, because in the next 20 minutes, I'm going to show you why understanding this one concept makes 95% of the trading advice that you see on the internet absolutely worthless. If you're new here, my name is Will Johnson. I'm a former professional Call of Duty player who's been actively trading and investing for the last 13 years. All right, so imagine this. You're sitting at a poker table, okay? Texas Hold'em, and the dealer slides you 2 cards. You look down, and what do you see? Pocket aces, baby. The single best starting hand in poker. You are ecstatic. So you do what any reasonable degenerate at the table would do. You move all in, push your whole stack into the middle. You're ready to go. Now, the fella across from you who's been losing his ass all night looks at his cards as well, but he is holding a 7 and a 2 of different suits. 7 deuce offsuit, statistically the single worst starting hand in Texas Hold'em. But this guy's a psychopath, and for some reason decides he's gonna call. So dealer flips the flop. 7 of clubs, 2 of diamonds, 3 of hearts. All of a sudden, my pocket aces don't look so good. Here comes the turn, and oh my goodness, it's another 7. Now, he's got 3 7s, and he hits a full house on the river. You lose your entire stack to the worst hand in poker. You're devastated, but here's the real question. Was that a bad play on your part? Now, the obvious answer is yes, I lost all my money. I shouldn't have gone all in. I should have been more cautious. Maybe I just called and tried to see the flop first. In that sense, yeah, it was a bad decision. But the real answer is more likely no. It was the best play possible in that situation. You would actually make that exact play 1,000 times out of 1,000, because when you put pocket aces all in against 7-2 offsuit, you win that hand about 85% of the time. The fact that you lost this one is really just noise. The 85% is the signal, and in the long run, the signal beats noise every time. Okay, so what is it? Expected value. Put simply, it is the average amount that you would win or lose per decision if you made that exact decision 1,000 times. That's it. That's the whole concept. Don't let anybody tell you that it's more complicated than that, because it's not. So before all the poker aspiring professionals come up in the comments talking about, well, Big T, sir, it's actually the probability weighted sum of all possible outcomes. We don't care. Okay, we don't care. So let's run the math on that poker hand, okay? You pushed all in with pocket aces. You win about 85% of the time. You lose about 15% of the time. Now, in order to keep the math simple, let's say that your bet was $100. So if we are looking, holy shit, is that an E? If we're looking to calculate the expected value, what we would do is take our 0.85 winning percentage times a $100 win and add it to our losing percentage times minus 100 when we lose. And what that gets you, if you run that math, is $70. The EV of that particular hand is $70. If you made that decision 1,000 times, you would make $70,000. So the fact that you lost this hand doesn't change the math. The math does not care about this hand. The math only cares about the average across a lot of hands in a row. And this is the part where so many traders lose the plot, is they get so focused on the trade that is in front of them. But the professional, whether it's in poker or trading or any game where you are dealing in probabilities and uncertain outcomes, they are focused on the process, knowing that they're going to make that same decision hundreds of times, thousands of times. So again, the single outcome is noise, but the average outcome over many reps, that is the actual signal. But this is a trading channel, right? So let's translate this over to trading, because we're not playing poker. It's a totally different game, right? So instead of thinking in hands, you just think in charts. Every single trade has an upside if it works and a downside if it fails. And you just multiply the probabilities by the outcomes, add them up, and you've got the EV of that trade. So positive EV means if you took that trade 1,000 times, you'd make money. Negative EV means that you would lose money. Simple as that. So we'll apply it to a trade here, and I'm gonna walk you through one specific setup, and we'll just keep coming back to this for the rest of the video, so that will make sense. So pay attention here. We're gonna go with SPY, the S&P 500 ETF. Everybody knows it, right? Let's say that the chart is pulling back into some level of support. Right? It doesn't really matter what the level of support is. It could be the 50-day moving average that you've identified. It could be some level that it bounced off 4 times in the last 6 months. It doesn't really matter. The only thing that matters here is that you've identified a spot where, in your experience, the bounce works more often than not. That's it. So let's put some numbers on it. This is why it's important to track our trades again, remember? Because based on your back testing of this particular setup, we're gonna say there's a 60% chance that this thing bounces. And if it bounces, you can ride it for $4 a share, $4 move. And if it breaks down through support and you get stopped out, you're gonna lose $2 a share. So you're risking 2 to make 4. If you simplify that down, you're risking 1 to make 2. So let's run that EV math. Let's, for simplicity's sake, again, say you're trading 100 shares. So we're gonna take our winning percentage, 60% of the time, times $400, and then we are going to add it to our losing percentage times minus $200, which is how much we lose. So EV equals plus 240 plus minus 80, that's 160. Jesus Christ, I hope I do this math right. That's $160 per trade. If you did that 1,000 times, you would make $160,000. And this single calculation, probability times outcome on both sides, add them suckers together, that is the foundation of every single trading decision that you will ever make, whether you know it or not. And starting now, I'm going to show you how it shows up in all of those decisions, even the ones that you probably don't realize are EV decisions. Starting with the one that everybody loves to obsess over, which is win rate. Almost every single retail trader I have ever talked to or began working with, they have very similar goals, and it's that they want to make money every day, which is a noble goal. Everybody wants to make money every day, but they want a high win rate, because when you're right 80% of the time, it feels good. And being wrong 80% of the time, well, it feels bad. It's pretty simple psychology there. But unfortunately in the market, this is one of the most expensive lessons that eventually you have to learn or unlearn, because win rate by itself is absolutely meaningless. Let's take trader A, okay? Trader A wins 80% of his trades. 4 out of 5 days a week he comes in, he's making money. But on his winners, he's making $100, and on his losers, he's losing 500. 80% times plus 100 is plus 80. 20% times minus 500 is minus 100. EV per trade is negative $20. So that same guy is right 4 out of every 5 times, and he's losing money. Over 1,000 trades, he's down 20 G's, despite being right 800 times. So congratulations on the win rate, brother. You are dead. Now, on the other hand, we got trader B, okay? Trader B, he only makes money 30% of the time. He's wrong way more than he's right. But on his winners, he makes $500, and on his losers, he loses 100. So once again, let's run that EV math. 30% times plus 500 is plus 150. 70% times minus 100 is minus 70. So the EV per trade is $80. That same guy who's wrong 7 out of every 10 times is making money hand over fist. Over 1,000 trades, he's up 80 grand, despite being wrong 700 times. So we like to chase high win rate because it feels good to be right, but professional probability people are chasing EV because that's where the money is. And I've spoken about this previously in other videos, but often in markets, those two things, win rate and risk reward, They are inversely correlated. So strategies with the highest win rates tend to have terrible risk reward, because in order to get that high win rate in the first place, you got to be willing to take very small wins and big losses. And vice versa, strategies with the best risk reward tend to have really low win rates, because asymmetric payoffs in the market just don't happen very often. So they require accepting that you're going to be wrong a lot. But to really boil this down a little bit, you don't get paid in the market for being right. You get paid for being right at the right size, at the right frequency, and with the right risk reward. So win rate by itself is a vanity metric, but EV is truly the only thing that matters. Now, let's go back to our SPY trade for a moment. Say you're in, the trade's working, SPY bounced just like you thought it would. Let's say you're up $250, but there's another $1.50 of upside to go to your target. What do? This is where a lot of people get in trouble and start to panic at this exact moment, because they want to lock in the profit. I've been wrong too many times before. I'm nervous. But Big T, they said a bird in the hand is worth two in the bush, right? So they exit early. And honestly, I get it. I've done that a lot. I get the feeling of like finally being green after a couple losers. It's seductive. It feels good. But why don't we actually run the math on this? Because if you exit early at plus 250, you are guaranteeing a $250 win. And if you hold for the full target, let's say there's a 70% chance that you get the full 400 and a 30% chance the trade reverses on you from this point and you give it back to your original stop at minus 200. Okay, run the EV on that. 70% times plus 400 plus 30% times minus 200. That's plus 280 minus 60. That's plus $220 of EV for holding that trade. So even though it feels safer to take the 250 in your pocket, the math says holding is worth 220 on average, but the 250 is guaranteed. Wait, the 250 is actually higher than the 220, so taking it would be the right move. The math actually does say to exit. Yeah, see, this is where it gets tricky. Now, flip the scenario, same trade, but the chart is breaking out strong. So now you're thinking the odds of hitting the target is like 85% times 400 plus 15% times minus 200. That's plus 340 minus 30. That's plus $310 of EV. Now, holding is worth 310 versus the 250 guaranteed. Math says hold. Do you see what's happening here? It's all math, man. It's just all math. But what about the most important math of all? Position sizing. All right, so now we're gonna start getting into the weeds a little bit, but this is really the meat and potatoes. Because you can actually have a positive EV trade, a positive EV trading system, and still go broke if you size it wrong. Let me show you what I mean. So say you've got a strategy with a 60% win rate, 2-to-1 risk reward. It's fantastic on paper. So you win 200 on a winner, you lose 100 on a loser. The EV per trade is plus $80. It is beautiful. It is positive expectancy. You take it all day, every day, twice on Sundays. Now, you've got a $10,000 account. How much do you risk per trade? Trader A risks $5,000 per trade, half of his account. He's got positive expectancy strategy, so he's gonna make some money, right? Wrong, man. You're risking too much. Inside your first couple of trades, you get 2 losers in a row and you are dead. The math says that a 2-loss streak at a 60% win rate happens about 16% of the time. So it's not even rare, like it's gonna happen. Now, Trader B, on the other hand, same $10,000 account, he risks $200 per trade, 2% of his account. He also hits the 2-loss streak, of course, but he's only down $400. His account's still sitting pretty at $9,600. My man is fine. He keeps trading. And over the next 90 trades, the EV plays out, he compounds. End of the year, his account is doing real work. So they both got the same strategy, same positive EV. Trader A went broke, Trader B got rich. The only difference between them was their position sizing. So again, EV is telling us whether the math is in our favor. The position sizing tells you whether you are going to survive long enough for that math to actually matter. So just remember, a positive EV trade with too much size is still a death sentence. You'll be right and broke at the same time. The market is a graveyard of people like this. And honestly, poker pros figured this out a long time ago. This is nothing new to those guys. There's a formula actually called the Kelly Criterion. It actually tells you exactly what percentage of your bankroll to risk on a positive EV bet in order to maximize the long-term long-term growth of your stack or your account without going broke. I'm not going to dive into Kelly math because it's actually very complicated, but the intuition is simple. The bigger your edge, the more you can size. The smaller your edge, the less. But there's a couple of problems with the Kelly Criterion, specifically with trading. One is that full Kelly, sometimes even half Kelly positions are psychologically unbearable to actually execute. The variance is like way too extreme for most people. So you'd be cycling through like near bankruptcy on the way to making money, and most people just can't take that and execute at the same level. So for most retail traders, the practical version is just the 1% to 2% rule. That's what most people in the industry go by. Never risk more than 1% to 2% of your account on a single trade unless you really feel like you got the nuts. And honestly, if you're new, you can risk even less, because what kills traders is not a single bad trade. It is surviving those bad stretches long enough for the math to actually work in your favor. Now, what about the frequency of your trades? Because a positive EV strategy is basically worthless if you could only execute it twice a year. Because again, EV is per trade math, and your wealth is per trade math compounded over many trades. So really, the total amount of money that you make is your EV times the number of times you execute. And that's why there is basically two valid paths in this game. Path one is small edge, huge frequency. Think your high frequency market makers and trading firms. Their edge per trade is tiny, like pennies per share tiny, but they execute millions of trades per day, and so they make a lot of money. Citadel makes more than most countries' GDPs. Now, path two is large edge, but being very patient with your holding. Think Warren Buffett. His edge per decision is absolutely enormous because he's holding for decades, and the asymmetric payoff on a great long-term investment is massive. So he doesn't need frequency. What he needs is patience, concentration, and sticking to his core competency. What kills most people is they got neither one of them. They got small edge, low frequency. That's the worst possible quadrant you could be in. So you don't have enough reps for the EV to actually play out. And you're also probably not trading enough size for the individual wins to matter. Meanwhile, you're paying commissions, taxes, emotional energy on every trade. It is death by 1,000 cuts. And so the fix is you really got to pick a side. You either build a strategy with enough frequency that your edge compounds quickly, or you can build a strategy with enough conviction and size that you don't need the frequency. When those trades come around, you just absolutely murder it. Both of those can work, but trying to do both at the same time typically does not. All right, now you've made it this far into the video, and so I got to keep it real with you for a minute, because if I left the video right here, honestly, I would be doing you a real disservice. Because everything we just talked about, everything you just heard, the EV calculations, the probabilities, the examples, all of it is true, but there is a giant asterisk on this entire thing. And the people who don't tell you about this, honestly, are the ones that you need to be skeptical of. In poker, the math is much cleaner than trading. It's not perfect, but it's cleaner. So when I told you that pocket aces beat 7-2 offsuit 85% of the time, the actual answer is somewhere between 85 to 88% of the time, depending on a lot of different things. The specific suits that are in play, who's blocking what, how you run the simulation, who's sitting at the table. So even in the cleanest possible probability environment in the world, where you can see both players' hands, you know that there's only 52 cards of the deck. There ain't never gonna be more than 52 cards in the deck. The numbers are still not perfect. But now think about that in terms of trading. In trading, you don't know the other person's cards. You don't know how many players are at the table. Shit, some days you don't even know what game you're playing. Every single moment in the market is completely unique. The setup that worked 60% of the time last year, it might work 45% of the time this year because something in the macro environment shifted. Or that breakout pattern that you like that used to have a 3-to-1 risk reward profile in 2020, well shit, it might have a 1-to-1 profile in 2026 because there's a different mix of market participants and that edge has decayed. And so now the same chart pattern on a $500 billion stock behaves differently than the same chart pattern on a $50 million stock. You see where I'm going with this? The same setup at 9:35 a.m. behaves a little bit differently than that same setup at 3:55 p.m. So when I say that a trade has a 60% probability of working, that number's not real. It's an estimate. It is a best guess based on backtesting and pattern recognition and experience. But the actual underlying probability, it's unknowable. In trading, there is no indicator, there is no fundamental research, there is no amount of backtesting that you can do that's going to tell you the true odds of your SPY bounce trade. You are guessing. And that's the part that breaks a lot of people when they first learn about EV, because they're going to say, okay, well, if the probabilities aren't real, then how is this entire framework even useful at all, Big T? And the answer is that the framework is useful for one reason. It forces you to think in averages instead of instances. So even if your probability is off by 10%, or even if your estimate of reward is rough, the act of just running the calculation itself is going to make you a better trader than one who doesn't run it at all. Because the decisions you make do have an expected value. Some decisions in the market have positive EV and some have negative. And your job, quite literally, is to take more of the first kind than the second. But you're not going to calculate it perfectly. You're going to calibrate it over time. The good thing about markets is you don't need to be perfect in order to make money. The more trades that you take, you will start to learn whether your probability estimates are too optimistic or too pessimistic. You'll learn whether your typical winners actually match the targets that you initially set before you got into the trade. And you create a sort of decision feedback loop, which is the whole game. All right, so let me wrap this puppy in a bow real quick for us. Think about all of the stuff that traders obsess over and the problems that they run into. Win rate, hot streaks, avoiding losses, picking tops and bottoms, cutting your winners too early, letting your losers continue further, revenge trading. You've got all of these bad decisions happening, right? Wrong, my friend. That is all the same exact mistake, all of them. It is the same mathematical sin wrapped up in 7, 8, 10 different costumes. Obsessing over your win rate is ignoring EV. Cutting your winners too early, that is ignoring EV. Holding on to your losers too late, you're ignoring EV. I could go on and on and on, but I'm just telling you, like, all of the decisions that we make in the market have to do with this same mathematical equation. And whether you pay attention to it or not, it doesn't make it go away. Okay, so here's what I want you to take away, especially if you're trying to do this thing for real, which is you don't get paid in the market for being right. You get paid for being right enough times, at the right size, with the right asymmetry, and often enough that the math actually compounds in your favor. Or to put it another way, the market is not paying you for being right, it is paying you for expectancy. So the next time you take a single trade, whether you win the trade, lose the trade, it doesn't matter. The only question that matters is, was it a positive EV decision, and would you do it again? Appreciate y'all tuning into the video. Stay safe, trade smart, and I will catch you right back here next time. Peace out, everybody.